So for months now, right, we've been seeing these headlines suggesting the UK rental market is finally cooling down. But today we're going to dig into the data and ask a really important question. Is what's happening a gentle cooling, or is it actually the sound of something snapping? All right, let's get into it. I mean, this is the big question on everyone's mind, whether you're a tenant or a landlord. After years of what felt like just frantic competition and crazy high prices, are we finally seeing some relief? And, on the surface, it really does look that way. You know those stories that were absolutely everywhere? Dozens of people fighting over one single flat, bidding wars that just sent rents through the roof? Well, they seem to be fading away. And all the big property websites, they're reporting a real slowdown. And yeah, the data seems to back this all up. Look at this. Tenant inquiries are down by a whopping 21% compared to this time last year. I mean, that's a huge shift. And at first glance, you'd think, great, the market is finally getting back to normal. Except it isn't. Not even close. When you actually look past that big headline number, the reality isn't some healthy market finding its balance. Nope. It's something much more worrying. All right, let's really unpack that drop in demand because I promise you, it's not what you think. This isn't a sign that, everyone's suddenly found a place to live. It's a symptom of a market that's really reaching its absolute breaking point. And this is the key idea we've got to get our heads around. It's called demand destruction. People haven't just magically found homes. They've been completely priced out of the market. The need, the desire to have a place to live is still there. It's the money that's run out. And the financial pressure is just immense. Right now, the average renter in England is spending 42% of their gross income on rent. And if you're in London, that number often shoots past 50%. Now, just for some context, the rule of thumb for affordable housing is that it should be under 30%. So these levels are completely and utterly unsustainable. So what happened to that 21% of people who were looking for a place? Where did they go? Well, they didn't just vanish. They've been absorbed into these sort of hidden forms of housing stress. We're talking about adults well into their 30s moving back in with their parents. Professionals being forced back into house shares. People literally having to leave their jobs and communities just to find a place they can afford. Let's be clear, these are not good. Okay, and this is where the whole story gets, well, really strange. In any normal market, right, if there's less competition from tenants, you'd expect landlords to just hang on to their properties. But what we're seeing is the exact opposite of that. I mean, just look at these numbers. The market is literally being pulled in two opposite directions. At the same time, tenant demand is falling by 21%. Landlord sales are accelerating. They're up 22%. More landlords are selling up now than they were at the absolute peak of the rental frenzy. It makes zero sense until you realize that these two things aren't connected in the way you'd expect them to be. See, the landlords who are selling, they're not leaving because they can't find tenants. They're leaving because of this perfect storm of financial and regulatory pressures that has basically made being a landlord impossible for a lot of them. So let's break down exactly what those pressures are. It really comes down to these three things. Think of it like a triple threat: soaring mortgages, punishing taxes, and a whole lot of new regulations and uncertainty. And honestly, this has almost nothing to do with whether a property gets 10 applicants or 30. Okay, first up, the mortgage shock. This is huge. A landlord with a pretty typical buy-to-let mortgage, when they have to remortgage, is seeing their monthly interest payments literally triple. We're talking going from around £330 to nearly £1,000 a month. That's an extra £7,000 a year in costs that has to come from somewhere. And a lot of the time, even today's record high rents just don't cover it. Next, you've got what's called the Section 24 tax trap. Now, because of this rule, landlords can't deduct their mortgage interest costs from their rental income before they pay tax anymore. And this leads to some completely absurd situations. Look at this example. A landlord could make £5,000 in actual profit, but they get taxed as if they earned £20,000. For a lot of them, this means their tax rate on their real profit is over 100%. They are literally paying the government for the privilege of being a landlord. And then on top of all that, there's just the sheer weight of all the regulations. I mean, each individual rule might make sense on its own, but for a small, part-time landlord, trying to navigate this constant stream of paperwork and safety checks and licensing fees, it just becomes this massive, overwhelming burden. And finally, there's just the fear of the unknown. That upcoming ban on no-fault evictions, for example, has created a ton of uncertainty. So when landlords are faced with a future that looks way more complex and risky, A lot of them are just choosing to sell up now while they still know how the process works. So, okay, let's put these two big pieces together. On one side, you have tenants being priced out, and on the other, you have landlords being squeezed out. This is not a market finding a healthy balance. This is a market where both sides are shrinking at the same time. And that is a really, really dangerous situation. And here's the most crucial point of all. Supply is falling faster than demand. Even with fewer tenants looking, the number of available rental properties is shrinking even more quickly. So that underlying shortage of homes, it's actually getting worse, not better. And that just means even fiercer competition for a much, much smaller pool of places to live. And this number is exactly why. About 2/3 of the properties that landlords are selling are not being bought by other investors to rent out. Nope. They're being bought by owner-occupiers, people who are going to live in them, which means those homes are leaving the rental market for good, permanently shrinking the supply. Now, you might be thinking, well, what about those big corporate build-to-rent investors? There's a hope they'll just step in and fill the gap. But all the evidence shows that's just not happening at the scale we need. They tend to target very specific markets, like big, shiny apartment blocks in city centers. They're not really interested in the normal houses and flats in suburbs and towns that make up most of the rental market. So where does all this leave us? Well, the way things are going, it looks like there are two possible roads ahead for the rental market. And spoiler alert, neither of them looks very good. Okay, so scenario one, affordability just keeps getting worse. More and more people are simply locked out of renting a place of their own, which leads to more overcrowding and people having to move away. Or scenario two, the economy improves, people have a bit more money, and that demand comes roaring back, only to crash into a much smaller supply of homes. And if that happens, the bidding wars and the massive rent hikes we saw, they'll be back with a vengeance. This quote from our source material just sums it up perfectly. The crisis isn't easing. It's mutating into something different, but just as damaging. The pressure on renters hasn't vanished. It's just changed its shape. It's gone from a crisis of frantic competition to one of slow, crushing unaffordability. So the big takeaway here is pretty clear. All those headlines about a cooling market, they're completely missing the real story. The system isn't rebalancing itself. It's fracturing. And that leaves us with a really unsettling question. The rental crisis isn't ending. It's just changing shape. And we have to ask, into what?